because investors, as we've been talking about, ignoring the uncertainty surrounding the debt talks. Investors still buying treasuries. In fact, they're on track to post a small gain for the week. Our next guest is a Treasury bull. Joe Balestrino is joining us. He is senior portfolio manager, also chief market strategist at Federated Investors. He's with us from Pittsburgh. Joe, glad to have you with us. Do you still think we can hit 2.5% and stay there somewhere in the next 3 to 6 months?
Yeah, Deirdre, it's not the odds-on bet, but I wouldn't discount it. We talked about it a couple weeks ago. In a world where all the stimulus is very rapidly going away and the emerging economies are purposefully slowing their growth down and they pulled us out of recession, add to that the uncertainty in Washington. Uncertainty usually brings money into the Treasury market, and I don't think there's any realistic chance of default or even downgrade. All of that can get us to very low yields.
Now, you point out that the U.S. debt is still considered a safe haven, but there's some irony, or there's certainly another way to look at it, in that if we can't get our act together, at least 2 credit rating agencies have fired now more than 2 warning shots. So this, in your mind, doesn't change investors' confidence when they consider buying treasuries?
It doesn't change their confidence, and you said it in the introductory comments, to the extent that no one's taking it seriously, and the market clearly is not taking it seriously. Flip to the minority opinion that we could get there, all heck breaks loose, so to speak, and it becomes an instantaneous worldwide calamity. And for that reason, we watched this book a couple weeks ago with Greece. We know how it's going to work out because it's the only way that it can work out. So they will come to an agreement. There will not be a default, and that's why the market is not so concerned today, and I think rightfully so.
Joe, what other elements are going to move the bond market right now? I mean, obviously, the U.S. debt situation is the biggest overhang, but there's the possibility of QE3. I mean, we heard those comments from the Fed saying that the Fed is actually split as to whether or not more stimulus is needed. How is that going to be factored into the way the bond market trades over the next few months?
Yeah, I seriously doubt that QE3 is on the table. Mr. Bernanke threw it out there because it's his job to throw it out there, but he added a condition this time. It's not just the economic growth or lack thereof. He said we have to have a risk of deflation, and clearly we don't have a risk of deflation today. So the real answer to your question is what it always should be. Once we get past the headlines of debt defaults and ceilings, it's the fundamentals, and the fundamentals are clearly weaker than they were 6 months ago, and that can get us to very low yields, surprisingly. And again, it's the same thing. If we're surprised on the downside because of the economy, employment being a good example, we will continue to be surprised on the downside in terms of yield levels.
Joe, where's the best place for a fixed income investor to buy with all of this going on right now?
I think at the end of the day, we still, and this will sound contradictory, we still really like the high-yield bond market. And the reason why, before you even ask the question, I would guess default rates are virtually zero. So the high-yield market can live very well in a 1.5% GDP world. That could be the world we're living in right now. You will have equity correlation on a mark-to-market basis, but you have virtually no default risk. Corporations are making a lot of money. You collect 7+%. That's a pretty good start in today's investment environment.
And stress tests from Europe, Joe, is this going to move our market at all?
I hope not, because it's an orchestrated feel-good exercise, and they're going to try to make everyone feel good. We've seen this before as well. If it helps the market, it's probably a selling opportunity because there's no new legitimate information there.
No new legitimate information. Treasury yields is still on the 10-year, possible going down to 2.5% in the next 3 to 6 months. Joe Balestrino, thank you very much.